All right. Hello, everybody. This is Mike Rixey again. I am the lead options instructor for NetPicks, and this is our weekly options recap. I do like to jump on Fridays just to recap what we saw that week, recap some of the trades that we've closed out of, and then also take a look at some new trades setting up for us next week. Next week is going to be an interesting week because we have the holiday mixed in there. We'll talk about that more in just a few moments. I'll walk you through how I plan on approaching next week. If you have any questions, as always, feel free to type those in at any point. You can always comment on the video. If you're watching the recording of the YouTube video, you can always comment on that video or email me directly. More than willing to connect. Mike@netpicks.com is the email address. So next week with Thanksgiving, what we typically see during a week like Thanksgiving week, when you've got the holiday right in the middle, second half of the week, Monday and Tuesday, chances are we're going to see some decent trading. Monday, I would expect normal conditions. As you get into Tuesday, we might see a drop off in volume as we get into the second half of the day. So I think if you're looking to be active next week, earlier in the week, the better, right? I just got done answering a few questions with our customers here on this topic. How do I plan on trading next week? I'm going to trade as I normally would. I'm not going to take the week off. If you plan on taking the week off, that's fine. I mean, there's no reason to adjust plans just based on markets. But I don't like to go to the sidelines all that often. And with technology these days, with most brokers offering the mobile apps, you can stay active without being in the office. You can be traveling, you can be on the road and still have access to your trades. And that's why I like to stay as active as I possibly can. As far as how I'm going to trade next week, I continue to look for a lot of vertical spreads, continue to trade a lot of credit spreads here, just trying to put the time decay in our favor. There's still a lot of uncertainty out there, with the pandemic really starting to pick up again. There's some shutdowns starting to pick up again. There's unknowns as far as what the rest of the fourth quarter and the first quarter of next year are going to look like. I say that because the VIX is still above 20. You still have more expensive options, more uncertainty being priced in. And I just like the credit spreads here because they provide a more forgiving trade. They provide us 5 ways of making money on those trades instead of just having one way of making money if you buy a call or a put. I'm not opposed to buying calls and puts. I'm just very selective as to when I decide to use those. So next week, I'll certainly be leaning towards more credit spreads, just trying to get the time decay working in our favor. And I'll show you some of the trades that I'm looking at here in just a moment. I'm looking at the technical picture going into next week. This is a daily chart of SPY. Those of you that have joined us here the last few weeks, you know that we always start out with the daily chart. I've got a variety of different moving averages on the chart, both simple and exponential moving averages. If we take a look here, let me zoom in. If we take a look at the last couple of days, notice that pink line on the chart. That's the 8-period exponential moving average. The last 2 or 3 days, we have been testing that level. So far, it has held. That's why I track this level all the time. It's a very predictable area for support and resistance. No surprise, the bulls are putting up a fight there. If that level breaks on the downside, we do have a nice little air pocket down towards the 20 EMA. That's the next green line down below. I would love to see a move lower. As I've talked about the last few videos here on YouTube and Facebook, I would love to see a deeper pullback. I think that would better set us up for another run to the upside. It would build some energy for a more sustainable move higher going into the end of the year. So that's why I'm watching this level closely here this afternoon. I want to see if we can break that level going into next week. So that level currently is sitting at 356.34. The level below that, 351.04 is the 20 EMA. Those are the levels that I'm looking at on the downside. Let's say this level holds. Let's say we rally. The volume is most likely going to be on the low side next week, and that typically favors the upside price-wise. If we get a move back higher, there's 2 levels that I'm watching on the upside. We have this swing high from right around just under 363, 362.75 to be exact. And then you've got the all-time high up at 364.38. Those are levels that we'll want to watch. If we get another push to the upside, I would expect markets to at least stall out there temporarily. I'd be very surprised if we just slashed right up through those levels without first pausing. So those are some areas on the upside and the downside going into next week. The volume continues to be on the light side. That's why it's been so difficult to break this 8 EMA. We really haven't seen volume come in much. You take a look, and we've just been stuck between 60 and 75 million shares so far this week on SPY. I want to see that number closer to 100 million shares. Definitely want to see that number pick up. It's most likely going to be after Thanksgiving week for that number to pop up. I'm not expecting any type of significant volume next week. But again, it's 2020. Anything can happen this year, right? I mean, nothing surprises me at this point. So we'll see if we get any type of headlines over the weekend or potentially early next week. We'll see. Maybe we do get a surprise move. But based on historical patterns, normally what we see in Thanksgiving week is a slower, low volume week. And we'll see what happens going into next week. Notice what we're seeing on the ATR. This is a pattern here on the average true range down at the bottom. This is what I've talked about here the last few sessions. I don't want to see this the range contract much more than it already has. We have been seeing great range for most of this year, but look, the last couple of weeks, I mean, we have seen that ATR really fall off a cliff. It's still at a pretty decent number historically. We're still above 4. That's really my line in the sand. I want to see the ATR stay above 4, but we're coming off of a stretch where we had it up in the 6.5 to 7 range. We have certainly seen the ranges start to contract, and that's another reason why I've been trading so many credit spreads. If you don't have as wide of a range, if you're seeing tighter moves intraday, I tend to lean towards the credit spreads, give ourselves the opportunity to still make money if we stay in a choppy pattern. The VIX, again, it is above 20. We're currently sitting at 22.5. We've seen the VIX above 20 for most of this year. It's been a very unusual stretch. It's a very historic stretch. You don't see the VIX stay this elevated for this long in most cases, but obviously it's 2020. Anything can happen, right? So when the VIX gets above 20, you're typically going to see higher priced options. They're more expensive if you're buying options. It's another reason why we've been using so many credit spreads. The VIX, the elevated VIX, just gives us more premium to collect. If we take a look at the internals, it's easy to come over and take a look and see the overall market's down. You've got the Dow down a couple hundred points. The S&P's down 12. The NASDAQ is trying to hang on to some small gains, but you've got some weakness here intraday. But when you take a look, the volume ratio, it's only minus 1.48 to 1 on the NYSE. We're at 1.59 to 1 on the NASDAQ. We're slightly negative on the New York Stock Exchange. We're slightly positive on the NASDAQ. The volume picture today, it's light overall, and what volume we do have is very mixed. There's really no clear-cut signal from volume. There's not a lot of volume conviction behind the move today. The advanced decline line, minus 149 on the NASDAQ. So even though the NASDAQ trying to hang in there, trying to hold on to some gains, there's actually more names moving to the downside than the upside in the NASDAQ. So important to point that out. It's not broad-based movement so far today. And on the NYSE, the New York Stock Exchange, we're at minus 460. What do I consider extremes here? What would indicate across the board movement if we saw plus 1,000 on the upside or minus 1,000 on the downside? We do not have either one of those at this point. All right, so another very mixed signal, very indicative of a choppy environment. That's exactly what we're seeing so far today. In the tick chart in the lower left-hand corner, that is a 15-minute tick chart. And the tick tells us at that very moment in time how many stocks are trading on an uptick versus how many stocks are trading on a downtick. Here again, I am looking for extremes, either above plus 1,000 or below minus 1,000. Any reading above plus 1,000 indicates a buy program. Anything below minus 1,000 indicates a sell program. Ideally, I would like to see clusters of extremes. We don't have that so far today. It's been very muted price action. And you look at that 5-minute chart of SPY in the lower right-hand corner. I mean, since the open, I mean, it's just been a pretty tight sideways pattern. Not much range to work with there intraday, at least on the S&P. Very typical, as I talked about Wednesday in our midweek update, and even last week for our weekly recap. The market's tired. We have a lot of overbought names. There's a lot of names that have had incredible runs to the upside. It doesn't mean we have to reverse immediately, but I think it's going to be more difficult for these moves to the upside to continue without, at the very least, a pause. And we're starting to see that trickle in here. Let's see what happens going into next week with the holiday. See if we can get anything on the downside to reset us for a potential push higher going into the end of the year. Want to review a couple of trades. Some of you may be existing customers, so I want to talk through a couple of topics that came up today with our students on our overnight pop trades. The overnight pop trades are positions that we look to put on Thursday afternoon going into Friday's expiration. These are trades that were in and out in 24 hours or less. They're very active trades. So one of the trades that we sent out yesterday afternoon was on IWM. This is the Russell 2000 ETF. We like to place these overnight pop trades utilizing credit spreads. We're banking on that increased time decay as we get this close to expiration. All right. Can you take this type of an approach with a long option? You could. It's too aggressive for our taste. We prefer to stack the deck in our favor with the credit spread. What we did is we went into the November 20 options, the ones that expire at the end of the day today, and we sold the 178, 180 call spread. What that means is I'm selling to open the 178 call, and I am buying to open the 180 call. So I'm trading two different options at the same time. In doing so, I have a fully risk-defined trade. We know what our maximum loss is right up front. In this case, our maximum risk was right around $140 per spread. The goal on this trade was for IWM to stay below 178. That was the strike price of the option that we sold. As long as price stayed below that level, we can make money. Okay, now what happened here today? Did we get a big move lower on IWM? Right now it's down about 22 cents. It was down more here earlier in the session. If you were to buy a long put and you got a 22-cent move to the downside, those options aren't going to move much. Once you factor in the time decay, you're probably down a little bit of money. On the spread, yesterday we opened the spread for 56 cents. We collected $56 per spread. And again, we are tying up around $140 of capital per spread to put the trade on. We ended up closing this trade out this morning for 15 cents. It gave us a $41 profit per spread, which at initial glance doesn't look like a huge profit, right? Well, it's still a 28% return on our capital overnight. And we were able to book that profit without getting a big directional move. Again, IWM's down 25 cents. It wasn't a big directional move lower, but we didn't need that big move lower. We were still able to book the profit. Anytime that we sell a credit spread like this, the goal is to buy it back cheaper, in this case, the next day. That's exactly what we did today. So it was a $41 profit per spread. $123 of profit if you follow our risk parameters of risking $500 per trade. So just a really great trade overnight. Did we get a big move in our favor? No, we didn't. Okay, we didn't get that big directional move lower, and we were still able to make money. This is why I love to use the credit spreads. They're just really powerful trades. Now, the question that came up was, why wouldn't I just hold to the end of the day? Why wouldn't I just try to hold and book the additional 15 cents of profit potential? Just let the whole thing expire worthless. The problem with that approach is as we get closer to expiration, these options become more reactive to changes in stock price. Things happen very, very quickly. What if we get that very famous Friday afternoon rally? We've seen it so often in the last few years. If we rally back higher above 178, we would go from a really nice profit potential to an immediate full loss. I was not willing to take that risk, nor did I want to sit there and watch the trade all day long. I would rather book the really nice profit, book the 28% return on our capital overnight, free up the rest of my day, free up the capital for the next round of setups. I'm not going to say I won't ever hold into expiration, but it's more the exception rather than the rule. I find far better results closing out of the trades early and taking the partial profit. Now, a second overnight pop trade that we put on yesterday afternoon into today's expiration was on symbol SHOP. This is Shopify. And what we did here, again, we were using the November 20 options. And we sold a put spread on Shopify. Selling a put spread is a neutral to bullish position. We had a neutral to bearish position on IWM. We decided to flip things around on Shopify and put on a neutral to bullish position. So what we did is we came in and we sold the 965, 960 put spread. So what that means is I'm selling to open the 965 put and I am buying to open the 960 put. We put that trade on yesterday for $140 per spread. It gave me around $350 of risk on the position. So for those of you that trade Shopify, I mean, you know, those options, they can get expensive. We were able to put this trade on and tie up right around $350 of our capital. So very reasonable trade, even if you have a smaller account size. Now, we ended up closing the trade out earlier this morning for 55 cents. It gave us an $85 profit per spread, 24% return on our capital overnight. Obviously, you can see the price down here at the bottom of my screen. Had we held on to the trade, it's trading worthless at this point. We would have been able to book an additional $55 of profit. Hindsight as a trader is always 20/20, right? We can always look back and say, we should have done this and we should have done that. But like I just mentioned, had we held, and let's just say the market decided to sell off in a big way, and Shopify, instead of being up $28, was down $20 this afternoon, we would have gone from a nice profit to a full loss immediately. I was not willing to take that risk. I would rather book the profit, free up the capital, and free up the rest of my day so I don't have to sit there and watch things all afternoon. So we had two really nice overnight pop trades yesterday afternoon into today's expiration. Again, less than 24 hours of holding time, and you're looking at a couple $100 of profit, only risking $500 per trade. That's a nice little bonus. It's a nice little source of income going into the weekend. So just wanted to review those trades. If you ever have questions on our overnight pop trades, I'd love to connect and walk you through those trades in more detail. Feel free to email me, mike@netpicks.com. More than willing to walk you through those in more detail. Let's next walk over, and instead of looking at the daily chart, let's take a look at our 195-minute chart. This is the chart that we like to use for our entry and exit signals. Let's go ahead and take a look at SPY. We'll take a look at the index products first, and then we'll move on over into some of the individual stocks on our list and walk you through some trades that are potentially setting up for us here going into next week. So bear with me here a second, guys. See if TradeStation will load up some data for me. All right, we'll start out with QQQ because for whatever reason, let's see if it pops up. There it is. Okay. So on the SPY chart, we've been talking for the last couple of weeks about how bullish momentum has been in place. We've had this really nice push to the upside. Our trend strength histogram down at the bottom, the red and blue histogram, did flip over to bullish mode. And we've been stuck in bullish mode now for the last couple of weeks with this really nice move to the upside. Just over the last 24 to 48 hours, we have started to see some weakness kick in. It hasn't been anything extreme, but it has been enough to see price action break below our red and blue line. That's the 8-period exponential moving average. Starting to see some weakness here. The trend strength histogram is still blue. I'm not looking for a short trade yet. I'm not looking for a bearish position yet because that trend strength histogram needs to go red first. We need to flip down below the zero line. We don't have that yet. However, the pulse histogram, it's that red and yellow histogram up top. Notice this week we did have 5 yellow bars in a row. What that indicates is price was between a 1 and a 2 standard deviation move on the upside. In other words, we were overbought. It does not mean price can't continue to head higher. It just means it's not statistically probable. Odds favor either a move sideways or a reversal in the other direction. All right? Notice what happened. We've talked about this pattern the last few weeks. For those of you that have joined us the last few weeks, we've talked about what happens when you get those yellow bars on the pulse. If we go back into September, we had our yellow bars on the downside, indicating an oversold condition. What happened soon thereafter? We saw a reversal to the upside. We had another oversold condition. Late October, what happened? We saw a reversal to the upside. Now we have our yellow bars on the upside. Now we're overbought. Look what's happened since those yellow bars started to plot. We saw a couple days of chop. Now we're starting to see things roll back over. It's a very repeatable pattern over and over again. How would I play it? Well, we talked on Wednesday about how I'm not interested in buying a long put. It's too aggressive on the downside, but I would be open to selling an out of the money call spread. Selling an out of money call spread is a neutral to bearish position. We make money if SPY moves sideways. We also make money if an SPY moves to the downside. So that so far is working. Again, going into next week, we'll have to see with the holiday week. I mean, low volume tends to favor the upside, but the only move that hurts me when I sell a call spread is a big move higher. That I am not expecting next week. So if you decided to sell the call spread like we talked about on Wednesday, so far it's working. Would I be open to selling call spreads now if you don't have the position on? Would I be open to initiating a new trade? Sure. I wouldn't be opposed to it going into next week. So we can take a look at SPY. We can piece that trade together here in just a moment for those that are interested. So just give me a quick second and I'll circle back to this chart. QQQ, the NASDAQ ETF. If we take a look at the NASDAQ, it's out of all of the index products, it was lagging behind. SPY, IWM, they saw impressive moves higher. The NASDAQ has just been stuck in this sideways pattern. It's the coiled spring pattern that we've been talking about here. QQQ, the NASDAQ does not like to stay quiet for very long. Out of this pattern, we will get a break. We don't know when it's going to happen, nor do we know in which direction it's going to happen in. But when it does break, when it does pop, we're probably going to get a very tradable move out of that pattern. What would classify a break? Well, you can see price action the last 4 or 5 days. We've just been straddling the AEMA. If we can break below the AEMA on the downside, that could lead to a very tradable move lower. If we start to break away from that AEMA on the upside, obviously that would lead to another leg higher. So the AEMA is a very crucial point that I am watching going into next week. How am I leaning? Based on what I'm seeing on some of the other individual stocks, I am personally leaning more neutral to bearish in the very near term, but I am still bullish when you start to go out towards the end of the year, into December, second half of December. I still would expect a rally. I mean, obviously anything can change between now and then. So when I say I am neutral to bearish in the near term, I'm talking about the next 3 to 5 days. Would expect at least an attempt at a move lower. And then past that, we'll see if that move lower can build some energy for another wave to the upside. At this point, how would I play QQQ? I have no positions on. Okay, I'm just kind of in a holding pattern, waiting for something fresh and new on QQQ. IWM, the Russell 2000 ETF. Again, it's been one of the strongest index products here over the past week or two. And I don't know why TradeStation's taken so long to load up the data here. So while it's loading up the data on IWM, let's take a look over at the trade page on SPY. And let's talk about selling an out of the money call spread here while that data is loading up. So just a few moments ago, I mentioned selling a call spread could potentially be a valid way of taking the trade on SPY. So let's go ahead and let's take a look at the December monthly options. The options with 28 days left to expiration. I'm going to open those up. I'm going to come to the call options on the left-hand side, and I'm going to go out to, let's start out with the 363 calls. Why did I go there? Because they have right around a 65% chance of closing out of the money. That's always going to be my starting point for selling a spread. Always want to sell the option that has around a 65 to 66% chance of closing out of the money. I'm going to right-click on the 363 calls. I'm going to go to sell and I'm going to select a vertical. That's going to pop up an order down at the bottom where I would be selling the 363 call and buying the 365 call at the same time. I am collecting 77 cents to put this trade on. $77 per spread is what I would be collecting. My maximum risk, the amount of capital required to place this trade, is $122 per spread. Very reasonable trade regardless of your account size, right? Put this trade on 10 times, still only have $1,200 of risk. Now all of a sudden you've got $780 of profit potential over the next couple of weeks. Here's why I love this trade. We've got 5 ways of making money on the position. My break-even point is at 363.78. As long as price stays below that break-even point, I make money. I don't care if SPY moves up, down, or sideways. Doesn't matter. As long as price stays below 363.78, we get to profit. We also make money from time decay adding up and from volatility decreasing. So now I've got 5 different routes that I can follow to make money. The current price of SPY is at 356.75. Right? So we've got almost a $7 cushion here that we can be dead wrong. SPY can continue to move to the upside by $7 and we're still okay. The only move that hurts me is a big move higher from here, which we're not expecting because the market is already overbought. So this is a neutral to bearish position. I love the credit spreads because they give us more ways of making money. Now, in fairness, there are pros and cons here. I just talked about the benefits. The benefits are the lower cost of the trade, having 5 ways of making money on the position. On the downside, I do give up the home run profit potential. The most I can make on this trade is $78 per spread. Even if we do get a big move lower on SPY, my profit is capped. I'm giving up the unlimited profit potential in exchange for a higher probability of success. So that is one potential trade that we would be looking at going into next week. All right. Everything I just talked about on SPY is true on IWM. Very similar looking chart, in fact. Very overbought on this 195-minute chart. You can see our yellow pulse bars down at the bottom, indicating prices between a 1 and a 2 standard deviation move on the upside. We're overbought. Doesn't mean we can't head higher from here. It just means it's tired. Chances are we're probably going to see a stretch of consolidation or even a reversal to the downside. That would have me interested in selling an out of the money call spread, just like we talked about on SPY, putting on a neutral to bearish position in the near term. Out of all of the index products, the 2 that are most attractive to me right now would be SPY and IWM. QQQ, I'm not really looking to do anything until next week. Some of the individual sectors, let's take a look at energy. We talked about this on Wednesday. Energy and the financials have been super strong here over the past a couple of weeks. Energy still very, very overbought. You can see the move to the upside here. However, we've had a tough time breaking below the 8 EMA on the downside. Still overbought. I still would love to see a deeper pullback. XLE down about 1% here so far today. It's a good start, but I want to see us break the 8 EMA first. If we can get a break of that level, I do think we have a nice little pocket on the downside. That's a pretty big pocket between the 8 EMA and the 50 EMA down below. All right. So we will track XLE. Definitely interested. You can go a couple of different ways on XLE. You could sell an out of the money call spread like we just talked about, or I wouldn't even be opposed to just buying long puts here. Okay. And if you were to buy long puts, if we take a look, if I were to buy long puts, I'd first want to wait to see the 8 EMA broken first on the downside on a closing basis. But if that happens, I would still trade the December monthly options, the ones with 28 days left expiration. I normally like to have between 20 and 40 days left expiration is a very typical range that I look for on the options that I trade. If I take a look at the puts on the right-hand side, I like to trade the options that are 1 to 2 strikes in the money. If we go slightly in the money here, if I go up to the 37 puts, gets me slightly in the money, plenty of liquidity here in XLE, and you're talking about $225 per contract. Again, pretty reasonable cost, gives you a bearish position. It is more aggressive. You only have one way of making money on the trade. You do need XLE to move to the downside, but I definitely like the downside in the near term. Again, I think the tricky part for most people, continue to see it on a regular basis, is most people have a difficult time blocking out what they expect the market to do in the long term. Is this market massively overbought? Are we overdone? Absolutely we are. But I don't want that to cloud my judgment in the near term. Okay, I am going to be open to trades in both directions. Could XLE continue to move higher in the months to come? Sure. But in the near term, and when I say near term, I'm talking about what's going to happen over the next 3 to 20 days. That's my universe. I don't care what's going to happen 6 months from now. We'll deal with that 6 months from now. I want to focus in on what's going to happen in the very near term. And in the very near term, I'd like a pullback on XLE. XLF, which is the financial ETF. Very similar story, very, very overbought in the near term. I definitely like weakness here over the next week or two. Would love to see a push lower in the financials. XLF is one of the financial ETFs that we trade. There's a few of them. There's some other ETFs out there, like an FAS, for example, is another financial ETF. But I also like to trade some of the individual names, like a Citigroup, Bank of America, JP Morgan, Goldman Sachs. They all have very attractive looking charts to me at the moment. And I don't know why TradeStation is taking so long to load up data. Apologize for that, guys. But basically what we're looking at on XLF and Citigroup and JP Morgan, all three of those have had impressive runs to the upside, and I would be looking to position myself with some bearish trades in the near term. Some potential long puts. Citigroup, I was actually looking at selling an out of the money call spread, putting on that neutral to bearish position. I would be more interested in the long puts if we weren't heading into that holiday shortened week. So I'm going to most likely lean towards the credit spreads. And then once we get past Thanksgiving, we've got a stretch there. We've got a block of time between Thanksgiving and Christmas that I'd be more interested in ramping up the aggressiveness, potentially looking at some additional long calls and long puts. And unfortunately, let's see if I can load up another chart, see if TradeStation will cooperate for me here and give me a chart of BABA. So sorry, I don't know why the financial charts are not loading up at the moment. But again, just to summarize there, XLF, Citigroup, JP Morgan, definitely interested in more of a neutral to bearish outlook in the near term. All three of those are candidates. The one that was really jumping out at me here earlier was on Citigroup. BABA, symbol BABA, definitely got clobbered. We had some news out of China here the last couple of weeks. BABA got crushed. We are seeing a really nice bounce to the upside here the last couple of days. BABA has definitely had an impressive move higher. What we did with our students here yesterday is we came in and we bought some long calls. We had an oversold condition on our pulse indicator. We had yellow and green bars plotting. No surprise that we saw price action start to stabilize here and reverse to the upside. It's a very repeatable pattern over and over again. When you get those extremes on the pulse, in the very near future, you will oftentimes see that reversal. And it's currently up. BABA's currently up right around $10 on the session today, on top of what we saw yesterday. Yesterday was a strong session as well. So let's go over to the trade page. I'll show you what we did here on BABA. Out in the December monthly options, we bought the 280 calls. We paid $4.35 for that position. They're now trading for around $6.50. So really nice trade, over a 50% return in 24 hours on BABA. Working great for us so far. Our initial target on these options, I would love to see 100% return. So our initial target is $8.70. That would give us that 100% return on the call option. So on BABA, would I initiate a new bullish trade now? No, it's already moved too far in a short amount of time. I wouldn't chase at this point. If I'm already in a bullish position, which I am, this would be a position I'd be willing to hold. We'll reevaluate it as the day goes on, but I think we're playing from a position of strength here. We've got some instant profits to work with. And if we do get that Friday afternoon rally, like we've seen so often here this year, we could very well get up towards that target level. So really nice profit so far on BABA, and we'll see if we can get a continuation to the upside. So here is that Citigroup chart. I was finally able to get it to load up. So you can see this impressive move higher on Citigroup. Definitely overbought, down about 1.33% today. Would be more interested in a long put position if we could get price to break below the AEMA. It's that red and blue line on my chart. So far, that line is holding. I need to see that level broken for anything significant on the downside. All right. So Citigroup, JP Morgan, XLE, IWM, SPY. Those are all on the top of my watch list going into next week. Still holding my position on BABA, like we just talked about. Those are really on the holiday shortened week. I should point this out too before we wrap up. On a holiday shortened week, not only do I tend to lean towards the credit spreads, but you have to make sure you're trading the most liquid products on your watch list because the volume is going to be lower next week. That liquidity is crucial. We've got to make sure there's enough volume and open interest for us to get in and out of trades quickly and at some decent pricing. All right. So index products, SPY, QQQ, IWM, some of the big ETFs like an XLE, XLF, some of the individual stocks like an Apple or a Facebook. Those are all probably pretty fair names to trade next week. I think you're going to have enough liquidity there. You're not going to have any issue getting fills. You start to go off of that watch list and go to some of the smaller products or names that don't have near the liquidity. That's where it might be more of a challenge. You may have to give up some on the price in order to get filled. So next week, absolutely crucial week to focus in on the most liquid names on your watch list. All right. So I am going to start to wrap up here for the week. Appreciate you guys joining us for our weekly recap. If you have any questions on any trades that I've talked through here today, feel free to type those in now. If you're watching the recording, you can always post a comment on the video as well, and I'll get back with you right away. Next week, going to be a little bit different. I still would like to jump on. We normally like to do a midweek update on Wednesday and then a weekly recap on Friday. I'll do my best to get on for at least one video next week, but with the holiday shortened week, we'll just wait and see what price action does, see how much we have to talk through next week. So enjoy your weekend, everybody. If I don't talk to you next week, enjoy your Thanksgiving holiday, and we'll hit the ground running once we get past Thanksgiving. So enjoy the weekend, everybody, and we'll talk to you here very soon.